Has the current 7% interest rate left you feeling uncertain about whether to rent or buy? Are you worried about growing rent costs or concerned that monthly mortgage payments could be out of reach? Today, we're looking at the real estate market from every angle so you can make the right call about renting versus owning at the current 7% mortgage rates. Now, when you see a 7% interest rate, it can raise concerns about how much of your monthly payment goes to interest. While it may sound steep, there are a few approaches that could help reduce the total cost of your loan. One option is to pay points up front, but that isn't for everyone. Another idea is switching to a 15-year mortgage rather than the 30-year. Yes, that usually means higher mortgage payments, but in many cases, the interest rate is lower and you'll build equity much faster.
Any of that sound reasonable?
However, those aren't the only ways to manage costs. You could look into making bi-weekly payments instead of monthly to chip away at the principal sooner. Shopping around different lenders and comparing offers can save you thousands over the life of the loan, especially when it comes to loan origination and other fees. If you improve your credit score before applying for a mortgage, you may land a more favorable rate, even in a 7% mortgage environment. Putting at least 20% down can remove the need for mortgage insurance, which in turn lowers your monthly outlay, sometimes by a lot. Some buyers also explore adjustable rate mortgages, or ARMs, if they plan to sell or refinance within a few years, though it's wise to fully understand how rates can change over time. In short, a 7% interest rate doesn't have to be a deal breaker. Whether you're considering paying bi-weekly, making a bigger down payment to avoid extra fees, or reduce interest by negotiating with multiple lenders, there are real steps you can take to keep your overall costs in check. Now that we've covered how 7% interest rates affect your monthly mortgage, let's see how locking in that rate compares to the changing landscape of rent prices. When you're renting, you're at the mercy of the landlord's decisions, whether that means a rent increase each year or even having to move if they decide to sell. Renewing a lease can feel like rolling the dice, especially if rent prices in your real estate market are steadily climbing. In contrast, when you lock in a 7% mortgage rate, your monthly mortgage payment stays the same for the life of the loan, giving you a little bit more stability and peace of mind. Plus, moving from one rental to another can be a drain on your budget. Truck rentals, packing supplies, and time off work, they all add up. Now, unless you've got an army of friends with strong backs and an appetite for pizza, you might end up shelling out a lot of money every time you change addresses. Owning a home at a fixed rate can offer a consistent monthly cost, fewer surprise hikes, and the comfort of knowing you can stay put as long as you choose. It's your house. Of course, as a homeowner, you take on expenses like property taxes, insurance, and maintenance. Still, many people find reassurance in a stable monthly mortgage rather than dealing with rent increases. It can also help you with long-term financial planning and budgeting, which is critical when looking at the overall real estate market. Now that we've weighed the stability of a fixed mortgage against rising rents, let's explore how building equity compares to having fewer responsibilities as a renter. Paying rent means you hand over a check each month and move on. Owning a home, however, gives you the chance to build equity. Imagine you buy a home for $300,000 at 7% interest rate. Your monthly mortgage might be higher than rent, but a portion of each payment goes toward paying down the loan balance. And if your local real estate market sees even modest appreciation, you may see your investment grow. Here's a real-world example. Sarah was renting a 2-bedroom apartment for $1,800 per month. Over the last year, her rent went up twice, eventually hitting $2,000. Her friend Alex bought a small single-family home for $300,000 with a 7% interest rate. Alex's mortgage payment, including taxes and insurance, ended up around $2,200 per month. At first glance, Alex is paying more each month, but at the end of the first year, he's built a few $1,000s in equity and gained any extra value if the property's market price has gone up. Now, Sarah doesn't have a repair bill to worry about. Her landlord takes care of those costs, but she's seen no financial return on the rent she's been paying. And that's the trade-off. If you own, you might face a roof repair that sets you back thousands of dollars. If you rent, you stay free from some of those large repair costs, but you don't gain equity along the way. Balancing these two factors is critical. If you're ready to handle maintenance or have a savings cushion for surprise expenses, building equity can be a major asset. So how much equity are we really talking about? CoreLogic comes up with a yearly report just on this subject of equity. National home equity Q1 2024 was up 9.6% year over year. That means that in the first quarter of 2024, the average US homeowner gained approximately $28,000 in equity during the past year. And overall, historically, home equity goes up year over year. You may need to put that into your equation when comparing renting and buying. If you'd rather keep things simple with fewer responsibilities, renting may feel less stressful, though it means you won't be building ownership in a property. Now that we've looked at both equity growth and ongoing responsibilities, let's talk about how your personal finances and budget priorities can clarify whether renting or buying is a better choice for you. Now, before you make any decisions about locking in at the 7% mortgage rate, it's important to do an honest assessment of your savings, your monthly obligations, and your future plans. Don't let fear of missing out push you into homeownership if your finances clearly are pointing you the opposite direction. Think carefully about how a bigger mortgage payment might affect your ability to handle unexpected expenses, contribute to your retirement, or maintain your current lifestyle. Many experts suggest that your total housing cost, including principal, interest, property taxes, and insurance, should stay within a manageable portion of your monthly take-home pay, often hovering under 30%. If you're already stretched thin by car payments, student loans, or childcare expenses, then locking yourself into a high-interest mortgage can create a stressful financial situation. Now, on the flip side, if you have a solid savings cushion, stable employment, and you're ready to stay put for a while, a 7% mortgage rate could be the right move. However, feeling pressure from friends or headlines can lead to regret if you're not prepared for the responsibilities of homeownership. Ultimately, the best path forward is the one that aligns with your financial comfort zone, employment security, and long-term goals. Now, let's talk about a few ways to make 7% feel more approachable. Facing a 7% mortgage rate can feel like a hurdle, but there are ways to nudge that rate closer to 6.5% or even 6%. One common technique is to pay for discount points. We talked about this earlier. Each point usually costs 1% of the loan amount and can lower your interest rate by about 1/4%, though this varies depending on the lender. So if you're aiming for a 0.5% drop from 7% to 6.5%, you might need to buy 2 points, which on a $300,000 loan could cost around $6,000. Bringing the rate down to 6% could require more points, and the price tag goes up accordingly. So make sure you have enough cash on hand and weigh whether the long-term savings will justify the upfront costs. Another approach is to request seller concessions in the sales contract. If the property has been on the market for a while or the seller is motivated to close, they may agree to pay some of your closing costs, allowing you to redirect that cash to buy down the interest rate. When drafting your offer, be clear and specific. For example, you could propose seller to credit this much money toward buyer's closing costs or rate buy down at closing. If paying the points up front isn't an option, you might explore a temporary rate buy down, such as a 2-to-1 buy down. In this scenario, your rate is reduced by 2% for the first year, then 1% for the second year before landing at the full rate. It creates a bit of breathing room initially, though you'll want to budget for higher payments later on. Some buyers plan to refinance if interest rates drop within that time frame. Speaking of refinancing, it's a route many take once rates move lower. Of course, there's no guarantee rates will fall, so see it as a bonus opportunity rather than a sure thing. Improving your credit score before applying for a mortgage is another practical way to secure a more favorable interest rate, sometimes shaving off a few tenths of a point. Even if you can't knock your 7% rate down too far, cutting out mortgage insurance by putting at least 20% down can lessen your monthly outflow by a lot in some cases. In the end, the goal is to explore every angle: seller credits, discount points, buy down programs, and boosting your credit score so that you can lock in the best deal possible in your real estate market. We've looked at the most important parts of renting versus buying at a 7% interest rate. Your decision might come down to your current savings, comfort with monthly mortgage costs, and how you see your finances evolving. These are just a few tips I can offer, and every individual's case is different. Feel free to reach out if you have any questions about your own housing situation or need more real estate tips. I'm here to help. There you have it. I've given you plenty of ammo to think about when it comes to buying at the current interest rates. Just like any other investment, a home purchase is not something to be taken lightly, but the rewards are definitely worth it if it aligns with your current needs. Got questions about any of the points that I spoke about today? Make sure to leave a comment below. I'd love to hear from you. Looking for more thoughts on high interest rate purchases? Then make sure you check out this video right here. Thanks for watching, and I'll see you on the next video.